welcome to yet another instalment of our Nucleus Wealth Insight series. Just a quick reminder that the following presentation is general information only and does not take into account your personal circumstances. Whilst Nucleus Wealth aims to present informing and sometimes entertaining content, please consult your investment professional, financial advisor, or better yet, speak to us before making any decisions based on any of the themes discussed in today's presentation. And don't forget that this is a live presentation, so feel free to drop any questions you like in the chat box below and we can answer them along the way. If you're watching this after the event, make sure you attend the next one so you too can participate in the live Q&A section of our presentation. Our presenters today include myself, Tim Fuller, a certified financial advisor who has worked with hundreds of clients over the years, helping to make the complex simple for companies such as AMP, Mercer and independent advisories. Sitting across from me, we have Nucleus Wealth's Head of Investments, Damien Klassen, whose 25 years in the world of finance has seen him as the founding partner and Head of Research at analyst firm Aegis Equities, Head of Quantitative Strategy at Wilson HTM, and was responsible for mining, energy and big data in the $60 billion global quantitative equity fund at Schroders, which are a multinational asset management company. And of course, for more information, please check out our people section at www.nucleuswealth.com.
Hello and welcome to our next instalment of Nucleus Insights. And this week we've entitled it "The Future of Financial Advice." So obviously quite a topical theme in today's media and today's news, given the recent unveiling and revelations of the Royal Commission. So we thought we might just put together a short webinar on some thoughts that we have going forward in the directions that we think financial advice are going. I'm here with Damien. Welcome, Damien.
Hi, Tim.
And we'll jump into it. So we've got the agenda today, so we're going to have a look at some potential Royal Commission advice outcomes, given, as I mentioned there, the revelations that we've been watching. We'll jump into, from there, the current advice, or a current advice snapshot of Australians and advice. Actually, there's a couple of recent articles that have come out in the AFR, which we'll be focusing on a few graphs there as well. And then on to the topic of the day, which is the future of advice and some of the pathways that it could very well be headed. So off we go into it.
Yeah, and we might jump. We're going to flip back around this time, and I'm going to ask a few more questions, and Tim's going to be in the hot seat for a change. But I think just to frame the aspects of what we're looking at is, I think, as I see it, advice sort of falls into three main categories. One is the structuring. So how should should it be in trusts, or should it be in your own name, or should it be through super and things like that? And there hasn't been a lot in terms of coming out of the Royal Commission and things like that, but there is a little bit about the structure of whether there's higher payments in super and things like that. So there's one part of that, but that's, I guess, less of an issue. The second part is then, that's the first part, is how do you structure it? The second part is then what types of products, and do they fit the right risk profile and things like that. And again, there's not a lot behind that. I mean, sometimes you find people pushing into higher paid products or whatever, but it's probably the third part, which is the exactly what products you should go about, you should actually invest in, and that's where you get this the conflict between people in terms of should you be putting people into products? Should you be advising people to buy your own products? And so I'm sort of going to keep coming back to those three sort of issues about the structuring, the types of products you're investing in, and then the actual product recommendation, and sort of how each one of those three sort of fits into Tim's framework.
Okay, sure.
But anyway, we'll move first to the Royal Commission and what your thoughts are from there.
Yeah, okay, sure. So look, obviously I'm a late blooming financial advisor, in the sense that I career progressed or processed or moved from an engineering background into advising in 2011, I think it was. It's all sort of in the wake of the future of financial advice reforms that sort of kicked in 2012, 2013. And a big component of that was lifting education standards. And so just recently, and probably less to do with the Commission, and yet intrinsically involved, I think, in some of the outcomes of the Royal Commission, is a set of frameworks, education frameworks, that have come through, and only recently has a financial advisor standards and ethics authority being appointed, which is known as FASEA in the industry. We love our acronyms. But the idea with that is that they're now trying to build an education framework as opposed to more of an experience framework, which is where advice is probably generally sort of tended to go. It was more about your resume and your achievements as an advisor, generally how well you were, how good you were at creating revenue, I guess, was probably one component. To then looking at now having to have hard education standards sort of applied, and there's 3 pathways there that you can see.
So FASEA, who do they report to? Who's paying for them? And
well, my understanding is that it's certainly, I think it's been put together by the government. So there's sort of there's a little bit of toing and froing at the moment, and these frameworks, I might add, are open to being consulted upon by the various bodies. And I'm a certified financial advisor, part of the Financial Planning Association, the FPA, and we went along to a session yesterday where this was obviously a very, very hot topic. And it was really about, okay, well, where does the advisor sort of networks of old fit into this new education standard? But I think the idea is that there's supposed to be now some more government oversight. For many years, it's been a self-regulating industry on how people can get in and get out of it.
Yep. And so in terms of penalties, because I mean that's the one I think most people sitting at home who sort of see all these things pop up, and banks pay hundreds of millions of dollars in fines and all that type of stuff, and nobody ever goes to jail. Or there's a few slap on the wrist, and somebody goes, oh, okay, you've lost millions of dollars and you put all this stuff into it, and please don't, you're not allowed to be a financial advisor again. And so from I guess the punter sitting back looking at that going, just a minute, somebody steals lots of money and gets away with basically saying go find another industry versus actually getting punished for it. Has this board actually got any?
Yeah, okay. Well, I think it's still. I think the key part about this whole fitting into this framework is then you are then able to call yourself a financial advisor. So without actually conforming to this framework, to this education framework, it's essentially going to be illegal for you to claim the title of a financial advisor or a financial planner.
Yep.
That's my understanding of how that works. And so by having that name and by being able to carry that, you have also then passed the test essentially, or passed the minimum standards for being able to carry that title. Where in the past, the ability to call yourself a financial advisor, you were able to because there was no prerequisite. It's like you can't call yourself a doctor without having the required education. So this is the direction they're headed with the advice community as well.
And having looking at that, 2024. So we're still talking 6 years away. It doesn't seem like an imminent solution.
To play the devil's advocate here, and I guess I suppose in the sense I'm somewhat the devil, but calling myself an advisor. But the key part here is that when you've got a collection of individuals, I think it's we're upwards of 20,000. Although we'll talk a little bit about what those numbers are going to look like in the future. There needs to be some time in which to do this, and particularly because, as you can see at the top of the diagram there, that there essentially if you don't have a degree or you've got a non-related degree, there is going to be a series of education which typically takes a long time, part-time university, and look, I haven't done it myself, but I've been to uni with part-time people, and it takes forever. To be able to fit in a degree in your spare time, turns a 4-year degree into 10 years if you're not careful. So look, I think there's got to be a timeline, but also there needs to be some firm lines in the sand if this stuff's going to stand up. So
yeah. Oh well, look, obviously a good thing that you haven't got your sort of your ex-used car salesman and your suit salesman and all that type of stuff, and your real estate agents hanging out a shingle and calling themselves financial planners. And
essentially that's right. And I think ultimately that's that's a side reason, if anything, for this. It's going to have, there's going to be an effect on this where people are going to look at the requirements like anything, and they're going to say, well, I find it's probably going to be easier for me to go and do something else rather than to do this. So hopefully it's stripping back the core of or the group of people back to a core of people that actually want to do the right thing and are happy to do that.
And so, well, you've got another slide on education as well.
Yeah. So the next one is just essentially as of so if you're not the previous slide was the previous chart was for people that are currently on the financial advisor register. And then this is talking about now for going forward for people looking to enter the industry, essentially for newcomers. Key thing here is that it's moving away from having non-related degrees and related degrees to now needing an approved degree. There actually hasn't been yet, and I believe the FPA and all the industry bodies are looking for the list essentially of what an approved degree is. We're having some educated guesses at that, but essentially it's meaning now that a person has to almost essentially start their career at a university sort of level, as opposed to perhaps myself who came from an engineering background and had to get the required certificates to go into the planning world. Now you almost need to start from a unit, from day dot at university to go, okay, I want to be an advisor. I need to pick an approved degree, and then I can move through the various FASIA ethics and bits and pieces to get out the other end. So it will make it harder, I think, going forward for advisors, and it will once again it will strip back the opportunity for people to become advisors through this way, rightly or wrongly. But at the same time, the people that come out the other side, you could probably be quite comfortable and quite confident that they're there for the right reasons. So hopefully that's where they're going.
Well, yeah, and playing the devil's advocate from this end is that they know what they're doing wrong rather than making mistakes and not even knowing.
That's true.
You don't know what you don't know. Whereas you could argue that with for some advisors who I've seen, in terms of the risk they're putting on their clients and stuff like that in the years gone past, is not because they're genuinely trying to do something wrong, but they just don't know what they don't know.
Well, that's right. Yeah,
they haven't come from a background of knowing this stuff. It's been a sales job.
Yep.
And so at least now you get to the stage where when somebody does something wrong, it's because they know what the right thing is, or they have learned it. They've decided not to.
And that's right. And I think that's the emergence or the evolution of the culture of the profession. Essentially, I think, and this is in my experience, and I've been in some majors as well, that when you've got high performing advisors doing fantastically well, 2 to 3 times what everybody else is doing, sometimes you've got to stop and think, well, are they making a decision when they put a person into this product that it's going to help their monthly target at the end, or the end of the month target, or the end of the year target, or are they actually looking to create something that is a client centric piece of advice as well? So hopefully all this work by doing the wrong thing going forward now, you're burning all this work that you're doing, aren't you? You're effectively, I think now more than ever now the oversight's going to be huge, and we'll talk a little bit about what the majors are doing with oversight. And that's going to make people, if anything else, if do the right thing. Hopefully that's an outcome.
Yeah. Okay. Well, let's move further into that. I've got my skepticism, but yeah, let's go into.
No, fair enough. So we'll jump into. Obviously, some misadvice. Well, certainly some revelations that have come out through the Royal Commission. So, obviously, AMP have been caught lying to the corporate regulator, and that's not an advisor level, by the way. That's a management level. So there's some cover up there that's going to kind of come out. Fees for no service was a key one there, and lying about that. CBA taking the lion's share of over $200 million worth of compensation paid over the last decade. To 310,000 financial advice customers. And then finally, a smaller player in the market, Sam Henderson, being hauled over the coals for what I see actually as a mistake that was made that's obviously now caught him out. But unfortunately, at the same time, it uncovered a lot of other things that he probably could have done a lot better, and he probably knew about as well. So anyway, they're my thoughts.
Yeah, well, it does come back as well. There's been a few people commenting on this, about saying, well, this obviously all the big guys are starting to move out. And the small guys are probably no better. It's probably that Well, it's hard to say. There definitely are some small guys that are better, but you know, if there's things being done wrong with the big ones, and the question is, does that mean that when all the big guys move out, all the problems will go away, or does it actually just mean that now we've actually got lots of small problems?
Creates a vacuum.
Yeah.
Yep, and I think that's come out through some of the commentary, and I think even at the Royal Commission through some of the big guys, that, you know, by removing a couple of big heads, you know, many smaller ones will appear. But I think this is going back once again to that core problem of vertical integration and aligned advice.
Yep.
Which leads us nicely into our next slide. So this was just a quick chart of an ASIC study they did over the last couple of years, looking at mainly the big guys, from what I understand, big four banks and AMP, and essentially found that 75% of the advice given in-house in these vertical aligned platforms. And for those that aren't aware, but a vertical aligned is obviously when you've got a planning unit attached to a product, essentially. So they're there to more or less to recommend, you know, the product. And so what they found was obviously that a lot of the advice that was coming through, 3/4 of the advice that was coming through, was not compliant in the best interest duty of the client themselves, and for varying reasons. But a lot of the time it had to do with the fact that you know, people were being blindly referred or recommended in-house products without a full and fair justification and review of where they currently are, which is quite often omitted, and also looking at other products that are available in the market. So, and this sort of leads into, I guess, a mass exodus. I think we're sort of starting to see here. All the big four have been in the process of selling down. Now, whether or not they've seen the writing on the wall, or these businesses have just hit their peak and they don't see any you know, green shoots in where it's going. I'll leave that one up to you to make your own decision. But, you know, essentially all the, you know, well, from what I've read anyway, that, you know, the majority, well, if not all of the big banks are just madly chopping away at their advice businesses and their life businesses as well.
Yeah. So I mean, it's a question to me. All this always comes back to your question of remuneration and incentives, because as soon as you tell people, I'm going to pay you like a salesman, but I'd like you to act like an engineer.
Yep. Then
the chances are you're going to get salesmen.
Yep.
In there, as you said, the people who are doing 2 and 3 times. And then when you tell those same salesmen, I want you to do a good job and compare, you know, my internal fund versus these external funds, but and make sure you do it properly. But by the way, if you put them into an internal fund, I'll pay you 30% more.
Yeah, that's right.
It's not hard to work out why these incentives, things end up the way they end up, I guess is where I'm coming from.
And look, it's tough. I've worked in the big licensees, for want of a better word, and you know, they're as holistic as you can try to be, even just simply because it's a lot easier to use products that are, you know, that are around the corner, you know, and when you're in and this is, you know, a big component of it is that when you've got a lot of clients, you're looking after, you know, a lot of demand, plus you're trying to find new clients, and you've got the opportunity to ring up, you know, a buddy of yours 2 floors up to sort out a problem that's come up easily, versus having to hack your way through another institution's security and all the rest of it in order to fix things up, or if, you know, or to check on something, or to move something around and rebalance and doing all these things. So it's sort of the alignment thing. It's not just purely you know, the devil of the salesman, but also the fact that it comes with all these benefits that make you know, that make an advisor's life a lot easier. So it's, you know, and that's just a simple fact of how it works. Yeah,
and absolutely. So it's that thought, isn't it, that if you've got so if I'm managing 200 or 300 clients and I've got a bunch in Aussie equities, and I've got it with 3 or 4 main Aussie equity funds, I can easily keep an eye on all those. But if those clients all came with their own industry funds and their own other funds that I haven't rolled them out on, I've left them all in the same funds, then now I've got to follow, you know, 30, 40, 50 different funds trying to work out what's up and what's down and why this one and this is one having management problems or what have you.
Absolutely. And the other thing too is that, you know, going back to this sort of referring in-house products, is that over time, the products, in terms of benefits and features and all these sort of bits and pieces, it's quite difficult to discern a real benefit, if that makes sense. Now, part of an advisor's job is to certainly to try and help people avoid the pitfalls of high fee loads and high fee loads and what's the word I'm looking for? Big commission products, which is getting easier and easier over time. I think most people can just Google and find that stuff out these days, through forums and chat rooms and everything else. But then you've got the component of actually servicing the client and having, not just having your day filled up with administration all the time. And that's where that vertical alignment piece, just sort of sings quite nicely into the job description of an advisor. Not saying that that's 100% correct all the time, but at the same time, it's just a fact of being part of a vertical alignment. It's just part of that. So,
yeah. Now, stepping into the rest of the
sure.
sector.
So, I'll just quickly break up. So this is a breakdown of the number of advisors last year in the major planning group. So there's only just a touch over 6,000 out of the 22,000, or 28% sitting in this chart. But the interesting part of it is that they all largely sit in major institutions. So they're all aligned. Charter being AMP and Count being the Commonwealth Bank as well. So the point of it all here is that it's very easy to tarnish the whole advisory group with the same brush. And I'm part of a small group of new coming advisors, and up and coming, the youth advisors, I guess, without saying their name out loud. But the key part about that is that they there's a lot of pushback now from this alignment. There's a lot of people see that they've gone and worked at a bank, and they've quickly realised, as I did when I was working in my earlier parts of my career, that this is not what I wanted to do. If you're trying to do the right thing by the client, but you've got a boss that's wanting something else, or his boss that's wanting something else, then it's not going to be a great and long-term relationship or helpful to your career. And I think we can see that now. So this is just a really fresh chart from an AFR article today, but it shows essentially that there has been a slow movement away from the alignment, which is the red and the black, and essentially the privately owned. And whilst as Damien mentioned before, privately owned can come with its own problems as well. But it shows that even in the last 4 years, it's nearly doubled the amount that have moved from the aligned space, or the overarching big four and those large licensees to the independently owned. So, without the catalyst of the Royal Commission, and I expect that to probably increase dramatically next year. But without the catalyst, it sort of shows that there are people looking to get away from those alignment issues. And just finally. One of the other big things that's sort of come out was, once again, an article today, which is quite timely, was that ratings, they're called advisor ratings, are a website that allows you or clients to put independent reviews and reports of advisors on there. They released a report that revealed that over half of the advisors that they've obviously had a survey of were looking to exit the sector, which may speak volumes to the impost of having to follow these new education standards. It may just find that people are finding the job too hard and compliance is too hard, and there's easier opportunities and ways to make money out there as well. But I suppose the key part is there that we've got a declining advisor base and a rising wealth base of the country, and you can see with the wealth sector there at 2.8 trillion, estimated to go to 9.5 in 2035. So the question remains on, how's that? What's that landscape going to look like? Are advisors are the resultant advisors going to become incredibly busy, or what can be done to the industry to make sure that this is being serviced correctly and everyone's getting a good outcome? I guess, and obviously the client being the main focus there.
Yeah, and it seems to speak that cost needs to go up, I suppose, in terms of the advice, if you want to attract more people to it, but the flip side is in a low return world, obviously the higher
absolutely
paying 1% starts to make if they were doing sort of 5-6% per annum, makes a pretty big dent in
absolutely look, and that's a key thing. The advice has to be affordable, and I suppose there's two ways to do it. You either you either get more advisors or you get more on your plate, so there's more volume coming in, so that you can do, you can be cheaper, I guess, essentially, like a supply and demand sort of model. The demand's certainly going to come, I guess the other way is you try and cut costs, and you find quicker and easier ways of being able to service your clients, and get more and more of, use more technology perhaps to help keep your costs, drive your costs down as well.
Yep.
Finally, just finally on the current advice, or secondary on the current advice snapshot, I just thought I'd bring up an overview of who actually gets advice in Australia at the moment. And as you can see there, the lion's share is obviously in the retired space.
So just for people listening in, what we're looking at is just the number of Australians seeking financial advice by age group, and just looking at that. I think when you look at the percentage of age groups advised, the 65 plus, there's only 16% of them advised, but it's one of the largest numbers. And then your 23% of your 55 to 64, I guess your transition to retirement type people, and the people who are either just retiring or just about to retire, are the ones who, I guess, are seeking the advice the most. But you hit back to the 20 to 35-year-olds, and only 4%.
That's right. Yeah, and look, this sort of, I think, marries into my experiences. But the clients that I've had would certainly sit in those upper age ranges. They're sort of getting probably. Essentially, this is where as an advisor, they're getting less of a performance sort of styled, investment sort of styled outcome, and more of a security and a trust sort of relationship, which is, I think, the bread and butter, and we'll definitely head in that direction for face-to-face advising, where people who aren't familiar with the internet and want to be able to pick up the phone and call somebody, and want to be able to discuss their life plans and have those put in place, or their retirement plans put in place. Yeah,
well, and I guess part of this, though, comes about from, we've added Australia's added compulsory super, and which puts us in a good position versus most other economies that are just paying out pensions effectively, and so they've got these big unfunded liabilities and all this, whereas we've said, no, we're going to put this in so people can afford their own retirement. The issue is that it's complicated, and if you're just getting a pension, I don't have to worry about it. Things I just show up, I finish my work and that's it, I'm done, and now can I have my pension, please? Whereas when you say to people, manage your own, you're actually saying, okay, plus I know it's complicated, and we keep changing the rules every couple of years or every couple of governments, so you almost need to bake that into your forecast about saying, I'm going to give you all this superannuation, but I also need to account for the fact we're going to have to take some of it back because it's complicated, and so
absolutely, and look, the key thing is that there was an old saying I remember back at one of my licensees where the question was, who needs an advisor, or who needs advice, and the correct answer was everyone needs advice, right?
Yeah.
And I think.
Which is a shame.
But it depends on the grade of advice and how it's how it's made available, and the cost effectively. There's no point paying more for something if you're not going to get a benefit back in some form. That's just common sense. And but then it's again about saying, well, what mediums do I have in my disposal to be able to service various needs, and still get a good outcome, or or at least leave the client in a better condition or state situation than before the engagement, because that's a minimum standard.
Yeah.
But yeah, look, the other thing I just thought we'd sort of just quickly touch on was that we sort of, Damien said before, but the 20 to 35, a very low percentage of under advice at 4%, and 35 to 44 only 13%. But of course, then we've got this situation where there is a significant sort of amount of the population, and what I've got on the screen here is Australia in 2016, what they call a population bulge, that shows the various age brackets and the amount of people, population in those age brackets, and you can sort of see there that there is a pretty significant amount of people in that sort of 25 to 40 range. That's the peak, that's the head of the bulge, that will be moving through potentially into needing advice. That's, I guess, and that's the point of I'm trying to make with this diagram. So, faced with the, or within the face of a declining advisor number, what's it going to look like? How is advice going to take shape now in order to service these people that in 5 years' time, in 10 years' time, are going to be either seeking advice somehow or trying to go it themselves and do it on their own.
Okay, so could I, before we jump into the future,
sure.
So can I just summarise, what I've taken from your discussion so far is that so financial planners have got problems with the structure of it, and particularly in terms of vertical integration is one issue that needs to be resolved, and that seems to be resolved from the banks all selling down. And so we'll
to
probably...
a degree, yeah, that's it's the tip of the iceberg, but it's a pretty big tip.
Yeah, and so it looks like we'll end up with a bunch of independent planners. On the flip side, we also have, as I said, almost half the planners actually looking to exit, and all these extra education standards coming in. And so there's going to have to be a big replenishment of financial planners if we're going to deal with the massive amount of money that's coming in the other side. So we've got this financial planners shrinking and making it harder, and more regulation, and on the flip side, more money coming in. And so so we're sort of left in this quandary about how can we provide good advice to everyone with when, even under current conditions, which is sort of more laissez-faire conditions, you'd expect to be able to service lots more people, but we're still only servicing 10-15% of the population, and so there's a lot of people not getting financial advice, and obviously the Royal Commission isn't helping.
That's right. Well, yeah, I think it was, essentially, unfortunately, it was the Royal Commission we had to have.
Yeah.
Look, coming back, as I mentioned before, but my entrance to advice was really in the vacuum that was caused by the future of financial advice reforms in 2012. So the licensee that I started with realised that there was going to be a bit of an exodus at that point, and started hiring, and that's essentially how I did the transition into advice. And I suggest there's probably potentially going to be something like that happening again in the near future, if another wave of people that aren't now happy to hold themselves to the education standards for whatever reason. A big pushback has been for a number of advisors is they feel like they've got the experience, which I'm certainly sure they do, but under this new framework now they've got to go to uni. And if you've been advising for 30 years, you're in the last 5 years of your career, and you've got to go and do a 3-year university course for 2 years worth of work, you're going to bring that forward. That's just common sense. So it's put people in a bit of a spot. So I guess that does sort of roll us into the future of advice. And I just thought I'd throw up just some sort of broad areas that people typically go to advice for. And I've sort of, essentially, I've probably put them somewhat in age order here, in the fact that in the early days, the savings and budgeting help to sort of get yourself established, insurance, sort of protecting yourself and young families, investment as you sort of perhaps roll off paying off a mortgage, if you're lucky enough to do that in this century, and then obviously retirement planning and estate planning and aged care. And there's sort of, and I think you certainly nailed it at the start there, Damien, that there's always two components here. There's a strategy and a structure, and getting that right for people that aren't able to do it themselves. Great reason for advice. But then quite often it is coupled to a product of some description. So, insurance, you need to find insurance products and policies that suit the situation. And you've got, investments, you've got to find the investments in the mix and the asset allocation.
And that was what I was just about to put on, is that, the savings budgeting help, there's no one really... I guess maybe there's some software programs and things like that to help you, but there's not really this big product push out there in terms of those. From the insurance side, there's a bunch of big life insurers who are basically saying, I have a product which is relatively complex and hard to sell.
Yep.
So I need somebody to sell it. And I need it face to face, because I need them to fear of God people into saying, what happens to your wife and kids if this happens, or what happens to, there's all that type of, it's a product that unfortunately needs to be sold.
It does. You're right.
And so they're basically saying, well, how do I need to get my product out to all these people, and if I can't pay these guys like a salesman, then I know they're not going to... If I have to pay them like an engineer, they're not going to push my product. And so I want to reward all these guys like an engineer. Whereas from the other side, as a customer, you need to be looking at this and saying, well, but I don't want my guy... I don't want him to put me into the life insurance product that pays the biggest commission.
Sure.
I want him to pay into the one that's best for me.
And
then coming through, that sort of fits for the investment guys as well. Retirement planning, not as much. It's really just a fight against the tax man there.
That's okay. Yep.
and estate planning, I guess, is a similar type of thing. There's a bit of legals, but the legals are generally a fixed fee legals, but there's not.
Yeah, and there's a component here of setup and then maintenance, I guess, essentially in the advice relationship. And certainly look, you could say it for all of them easily. But the insurance and investment and probably estate planning to a degree, since people change, lives change, and people drop in and out of wills, etc. So it's about pricing that, and you touched on something interesting there before with the insurance. So insurance still sits in this this commission based environment, and they're still not too sure what they're going to do about it because it needs to be sold. It's one of those things where if there's a tax benefit or you're going to make money out of it, people will run into your door. If you've got to pay money to protect yourself against something that happens in the future that may not happen, then you've got to go out and find people and make them think about it at least. Maybe not sell to them, but have a product available if they find that that now they've thought about it, they want it. So that's the way I view insurance. But the key thing there was that after the future of financial advice, the investment commission side was stripped out, and so that got knocked on the head. Whereas the insurance has remained for the last sort of 5-6 years.
And insurance commissions are big.
They have to be. Yeah, that's right. And they are loaded. They're loaded up. And look, I know advisors who actually take that load out as they strip the commission out, which quite often drops the cost of the insurance by upwards of 20 to 30% as a long term sort of premium cost. And
but as an advisor, if you're looking to put somebody into an insurance product,
sure,
what type of fees are we talking?
Well, this is it. Well, this is where you've got to say for people that are in that position, and guys I know that do exactly that strip out the commissions on insurance. One of the good things is it can make a client quite sticky to you, because if they go elsewhere, they'll probably load them up with the commissions again, so they've got a good price.
Yep.
But the flip side of it is that normally that would be built into a holistic plan where obviously they need to make money. They've got to keep the lights on in the office, so they'd be looking at creating an ongoing service plan or something with for the clients.
But
other areas.
If you're a typical 30 to 50-year-old with $1 million, looking for $1 million worth of life insurance or something like that to cover your mortgage, or half $1 million to $1 million to cover your mortgage and get your kid through school and stuff.
Spot on.
In terms of commissions, like we're talking thousands of dollars for
easily
advisors.
Yeah. That's right.
So that's so it's not I guess where I'm trying to get to with this is there is a big incentive to sell these products in terms of saying, if I can get one person across the line, I might get $5 or $10 grand as a commission.
That's right.
In my first year, and a trail on that.
That's right.
It's obviously that's a big sell for people.
Absolutely, and that's where they are tinkering with that a little bit now. There's been some reforms with the life insurance, the way that it essentially is remunerated, and they're looking at smoothing that out, perhaps. So rather than having one big upfront, which is quite often how you can take your commission as an advisor, forcing people into these more hybrid, ongoing sort of smaller commission amounts. So it keeps. Two things is one, it sort of stems what's called churning, where you change over new policies every few years and you get a big hit of commission, and rather it goes, okay, well this is this is going to be a long term proposition for my clients, so I'll do the homework a little bit more perhaps, or start doing the homework, however the case may be, because I know that I'm going to have this smaller ongoing revenue stream as long as they're happy with the product, and ultimately if it works for them, then they'll potentially keep paying and be a client. So. But we've spoken a lot about that sort of product angle, and I guess I've just got this sort of rough graph here of what I've sort of seen some advisors, not all, as a product distributor in their current form, and I think that what's going to happen.
And when you say a product distributor, you basically mean investment companies come to them and say, "Can you please sell my fund or my whatever?" and they take a commission on it and sell it to
probably
advisors.
Probably even more so than that. So this is more of your aligned advisor who gets gets paid a salary, and has a certain target that they need to reach. Be it 2, 3, 4 years down the track. Otherwise, they're probably going to be moved on.
Yep.
So effectively, they're just the sales force, as we said before, of whatever product provider that they're sort of working for. I think the big thing with the Royal Commission now is it's going to change that. So now it's going to be saying, okay, well, you as the advisor are going to have, the culpability of what you're recommending. So we're going to try and remove the alignment angle, so you don't feel compelled to, potentially, recommend the same products all the time because it just so happens you work for them, but instead turn into someone who needs to review and assess, products in the market. And this is a really tough sort of job now to be in, because rather than saying, okay, I know the pros and cons of a handful of products for a product, for a product provider or a couple of product providers, what do you do as an independent advisor? Do you say, okay, well, now I've got to sit down and research every product that's available in the market?
Yeah, and to put that into perspective as well, even something as simple as the exchange traded funds. I think there's more exchange traded funds now than stocks in a number of different markets, just because you can break it up so many different ways, and there's so many different product providers trying to add a clip of fee and get these low cost fees out for saying, well, if somebody wants to buy, this particular sector, great, I'll bundle it up for them and manage that for them. So
well, and that's the whole thing. And then it becomes, okay, well, what's my focus as an advisor? Am I going out and driving outcomes for my client and finding new clients, which is a big part, probably 60 to 70% of a young advisor's day is client generation, finding clients and finding avenues of getting clients, coupled with the fact that now I need to know absolutely everything about the strategies and legalities and complex tax, changes to superannuation, and then I also need to be on top of my products as well. So it's a big job, and I think ultimately it's someone's going to need to pay for that if you haven't got a licensee paying for it. And I guess that sort of moves into an area I think that's probably, that may or may not take off. Now, this has sort of been thrown about. I didn't think of this actually. Alex Vikovic from the IFA, hi Alex, if you're listening, brought this one to my attention. But I actually think this is a potential of where advice could go, where they sort of we'll touch on the first one in a moment. But the financial advisor / planner designation, as it sits under the new education standards and all the rest of it, will bring the ability for an advisor to have a holistic advice ability. But will not be aligned, will be fully independent, whatever that actually looks like in terms of a gold standard. They won't have commissions or be subsidised in any way, but of course they're going to need to charge more. And so I think for a person that's wanting the best outcome for themselves and really knows nothing, this is probably where they're going to need to head now. They're going to need to say, okay, I want to, here's my goals, and I want you to go and find products and build me a big plan, and I'm happy to pay, quite a bit up front. Whether or not it's ongoing as well, I guess, is up to the outcome of the advice and the needs of the advice. But then I think there may...
And putting that into perspective though, as well, like if I'm a high net worth individual, and I'd like to hire an accountant, or I'd like to hire a lawyer, I don't turn up to those accountants and lawyers and say, well, can I give you a percentage of everything I've got in order to do all my legals for me or to do all my accountancy for me?
Yep. And
so if it's just if it's advice, the question is, if I hire these guys on an hourly rate, well, why can't I hire a finance specialist?
Absolutely. And there's many people out there that do hourly rate work, and the pricing is always going to need to be reviewed. I think the way that people do price what they do, but I think the other side of it is that the expectation needs to be now that clients are going to have to pay for it. And I think moving from the older line space where, and this is going back before I started, but advice was largely free, because there were that many commissions and percentage loads that were for products, and especially investment products, that you could get all the advice you wanted for nothing because you're paying 4% a year exactly. At the other end.
and the argument from a lot of the people is going forward about all the reforms is saying, but if we do this, we'll have to charge for advice, and all these people won't get advice that really should get advice. And the flip side is saying, well, yeah, but the only reason they're getting advice is because you're getting a massive commission on it. So, the fact that my used car salesman is giving me great advice about which car I should be buying, is not something, that I really should be taking into heart. That isn't that great advice? And if I have to pay that guy by the hour, that I'm not gonna get that same great advice about which car to throw me into.
Yeah. So, and that sort of leads me into the second part, and this is potentially a new role that may arise, or maybe sort of given some leeway perhaps from an alignment sort of from the general feel of the Royal Commission and where they're sort of headed. But there's a sense for mine that I think that there may be a role created that you can't. I wouldn't say you'd be able to call yourself a financial advisor or a planner, but you'd be able to call yourself, or the term would be like a product facilitator sort of sense of the word. So you're already in the product, or you come to the company because you like the company, you trust the company, and you want to use the company. So so it gives you. It'd be a limited sort of process in the sense. It's got, like, without dipping too much into your used car salesman, maybe I'll use the term new car salesman. But if you like Ford, you're a Ford man, you go into a Ford dealership, you're going to get a Ford.
Yep.
You might get a new Ford. They're going to weigh up and they're going to say, this, that, and the other, and they'll tweak it. But at the end of the day, it's intrinsic in the sense that you know what you're going to get at the other end from a product point of view.
Yes.
But what you do is you want to make sure that you're being set up correctly in that product. So clearly defined from, okay, find the best product for me, to, okay, this is what I need from you guys. I'm happy to use you guys, and give me some advice, some quality advice that gets the most out of what you've got in front of you. So, and
I think coming back to what I started with, my three sort of lines, I think what you're saying there is, okay, so there's this structuring part which either of them can do, because there's not a lot of it's us versus the government, so
yep.
in terms of tax and stuff like that. So there's not a lot of conflicts there. There's what types of products should you be buying, and either one of those, so that the Ford guy can tell, right, I need to put you into a small one versus I need to put you into an 8-seater, or whatever it is. And it's that third part though about which products should I buy, is that the facilitator hasn't got the designation that you don't feel as if you're turning up to a car salesman.
Absolutely.
Yeah. And when you see that, whereas when you see the financial advisor, you say, okay, now I'm speaking to the doctor or the lawyer who's not incentivized to
Absolutely.
hopefully not incentivized to be into whatever medicines or whatever they're.
That's right, and I think because that would give, because the other side, the flip side of this is that and this is rightly or wrongly might be the landscape where products will just disappear, and only the strongest will survive. Now, the strongest may be the best for one person, but it's probably not going to be the best. It's always good to have choice, right? So if through the legislation or the way it all sort of pans out, you're giving product providers the ability to internally get the best for their clients. And not call themselves advisors, and no passing off, that this is an independent thing and all the rest of it. Then I think that then ultimately product development will continue. Otherwise, we're just going to end up with Amazon Super or something that's going to be worth be so cheap that no one can recommend anything else because it won't be as an independent advisor, you're not doing the right thing by the client. So that's the scary bit.
So with and we've spoken before offline about this sort of gold star designation that some of the. So can you just so for people who haven't heard about that, there's a type of financial planner already that's sort of designated as a gold star financial planners. Can you sort of go a little bit into what they provide?
Yep, sure. So
are they already down this line? I guess
Yeah, essentially, yeah. So there's the Independent Advisors Association. I think it is IFPAA. They're renaming it at the moment, but they've basically created their own steps, which is essentially that they're obviously being completely unaligned and have an independent license, not getting commissions in any way. They go another step where they don't charge a fund-based or an asset-based fee on that, so it's a fixed fee as well, which is an interesting one, and it's growing now. I remember actually at this FPA thing yesterday, I was talking with an advisor. We were talking about exactly this. IFAAA it is, IFAAA, and and we were saying the way that I think there was about 9 5 years ago, and now there's like 150 or something that so obviously there's demand for it, and people are heading in that direction. So I think that look, that's a good example of potentially where it's going to go.
Yep.
And I think for most people that have had a bad advice experience, that are sick of the aligned the aligned nature, and they just want the gold standard, so to speak, that they know that that people are part of this. That's potentially an area where people are going to head. Absolutely.
Yep. Yeah.
Sure thing. Finally, I guess, and just to sort of wrap it all up, and this is a new, I guess, one of these, there's a new paradigms in advice, I suppose they call it, but the technology advances that are coming through on the way that people can engage advice, and I think there's always going to be a role for a face-to-face traditional advisor in some element, however that sort of pans out. But people just like having a face, they like having a phone number, and there's just always going to be that segment of the community that is not 110% on the internet 24/7, and so that's going to be there. And then the next component being sort of this Robo Advice, and look, we use Robo Advice to a degree in what we do at Nucleus Wealth. And it's very limited in what it does. You've got to shape it, and you've got to set the expectation that this is exactly what it does. And I'm very happy to take it on this limited basis, and we're that's an easy way for us to provide our investment risk profile and recommendations on our own internal stuff through there. And then what we're seeing now is. So obviously the Robo Advice piece is blown up in the States over the last sort of 10 years, sort of post-GFC. But the flip side of that now is that it was the interesting fact that sort of came out the other day was that these big Robo Advisors, so Betterment and Wealthfront, a couple of them, they've got Vanguard, a massive one as well. They're actually now finding that their client list has moved from the Robo Advice initial sort of, okay, get me up and running and let's get some assets going, to now needing some form of human intervention and that sort of side of things. So this is now brought on the fact that these guys are now the biggest net hirers of financial advisors in the country, because they're saying, well, we've got this need that can't be serviced through our our online portal or our algorithmic sort of style that we do things. And so they've brought into this new sort of hybrid model. And I suspect, as sort of touching on before with the work that's now ahead of an advisor that wants to call themselves independent and research all these things, is they're going to start needing to look potentially at some of this automation in the more sort of the easier sort of low-hanging fruit sort of parts of engagement, in terms of being able for a client to be able to log in and do things themselves and at all hours, so that they don't have an email list in the morning that they've got to go and change a few addresses and do all this admin. And so, for me,
or you end up with people on that list who can afford to pay for it, who are happy to say, I'll, change this stuff for me at X dollars per hour or whatever. I'm on a retainer to do that.
But it's also then having potentially partnerships with product providers that can take some of that load away from an independent advisor and say, okay, well, let's get you back to focusing on what matters to you, which is great outcomes for your clients. So very good.
Yeah, and I think from my perspective, I'm producing an investment product, and you like people to be selling that investment product for you. I mean, having more advisors taking your product and selling it rather than less is obviously important. But the question is, you don't want to be in this in a bidding war to sort of. You don't want your end clients going, well, if I load it up with an extra 1% so that all these extra other people will sell it for me because it's got such great fees, such great commissions from it. But then the end client actually doesn't end up with a product that's with any benefit. Yeah, that's right. They're losing X% per year by having these people. So it's about trying to come up with that model where you can where you can be, people can be selling your product for you, but you don't feel as if they're just sitting there stealing from the margin, and they're actually there adding value, and the fact that they're putting people into your product is a net beneficiary. And so I think that's where we're certainly trying to work out the part for us is that, as you said, we've got this Robo Advice side of it, but there's an acknowledgement that people need to speak to people.
Absolutely.
Just to clarify stuff, and most people don't actually need day by day or month by month. Most people are just every few years check back in and those types of things. And how can you provide a model to these people that doesn't run into these vertically integrated? Because so it's about trying to separate that advice to go, well, as you said before, once you've chosen to buy a forward, okay, now we want to give you the best possible decision whether you want to hold or Ford or Toyota or whatever.
Leave that up to you or your dad or whoever.
We can help you with the lining them up. Here's what's different, but in the end, that's your that's the decision people need to come back probably going to need to make themselves or make with an independent, a fully independent advisor.
That's right, and look, and one of the key things for us is, given everything here, and obviously just not wanting to fall into that trap of this vertical alignment sort of advice, is that we now are in the position where we're looking for advisors that want to run the ruler over our product, and so if there's any advisors out there, or if you've got a good advisor, please get in touch to essentially, I'm very happy to have a chat, because for our goal here is to really create a product that someone that isn't being paid, that isn't aligned, wants to recommend to their client. To us, I think that's the perfect scenario for what we're trying to do in the creation of our models and our platform with Nucleus Wealth.
Absolutely. And you're not saying, well, I had a 2-hour conversation with somebody 10 years ago and he's still taking a clip because he sends me an email every year.
Yep.
It's about going, well, I had that conversation, I paid for it at the time. Now I've got my product and I'm paying a much lower fee for that product. And then when I get an inheritance in 5 years, or we get a divorce or whatever it is, and I need to go back to the advisor, I'll go back and pay the advisor.
Yeah, that's right.
When that happens.
Yeah. Pay up, get the advice, and don't pay for any more than you need to. There's a final question we got here. Do you think there's a need for an industry-wide or government drive to significantly increase public understanding of pensions and outcomes, starting with secondary education system? That's a good one. It's from Gunner Manor.
I want to jump in first before you.
Yeah, sure. Fire away.
Look, it would be good, except my problem is by the time anyone you stuck through in high school, by the time they make it to retirement, they will have either forgotten or the rules will have all changed.
Landscape's changed, absolutely.
And so I think what you're getting onto is the right point, though, is that if we're going to give every single person in Australia superannuation and tell them to manage their own affairs, is that does create an issue, and we need to come up with a solution for mass markets that deals with just the average person. They've been on a wage, PAYG, all their life. They've built up superannuation balance, and they just need the right, some simple advice to get into the right part.
Sounds like an industry fund, Damo. Where are you headed with this?
Yeah. Well, I guess what I'm saying is there's a need to satisfy sort of, to me, it's 70-80% of the population very quickly and easily.
Yep.
And it's the other 20% who have all the complicated structures and their own businesses and bits and pieces. They're the ones that need the big ticket advice.
Yep.
But I guess that's my issue with education.
Yeah, look, the key thing here is, look, I'm a strong advocate of financial education in schools. I just don't think there's nowhere near enough, unless a kid does economics, and whether...
Well, and even economics isn't really helping you much for your own... knowing
Absolutely.
GDPs and things like that, it doesn't help you with managing your own pensions.
Absolutely. And look, there's a number of programs out there that are trying to do this, but it sort of feels like it's the industry pushing in to the school system rather than the school system pulling in, if that makes sense. Now, I don't know why that sort of situation's arisen, but, like we've got just recently the whole Dolomite sort of scandal with the CBA, which I think for many years probably maybe started with its heart in the right place in terms of getting education for kids and saving, and then suddenly turned into, okay, we're going to offer them a credit card at the age of 18 because we've got this big mailing list. So, you like to think that there certainly should be more. There should be more in there, because at the end of the day, obviously the schooling stops at 17, 18, and then the real fun begins in terms of money. Anything you read about the way kids deal with money, and you sort of think, well, they don't know any better. I think that the onus is on people to do that. We've got one more question here. I would argue that the average punter knows far more about buying a car than they do about their super. That's a good point. Yeah, I'd agree with that. And that's probably, it's a focus on the now as opposed to the future as well, though, isn't it? And a big part of financial education is about delayed gratification and the power of investing and compounding and all these sort of things. So maybe that's a bit that's missing.
Yeah. Well, and the other big issue that that does rise from that is that there's a lot more. He's right in terms of that. There's a lot more financial companies than what there are car companies. In the end, you go, okay, I know there's 6 or 8 companies I'm really interested in. There's probably another dozen smaller ones if I'm into that type of thing. But once I've gone through my big car brands, whereas the financial market is obviously a lot more diversified and there's a lot smaller players scattered right throughout, so it's very hard to know them all.
Yep, sure thing. Okay, very good. I don't think there's any more questions there. So we'll jump into a bit about Nucleus Wealth.
Nucleus Wealth and the Macro Business Fund was put together to help give you access to quality, well-researched stock analysis and superior macroeconomically minded asset allocation. We use technology to help us provide a service typically only available to high net worth and sophisticated investors at a fee level that rivals the more basic solutions available to these everyday investors. We do this by using separately managed accounts, which allows clients to enjoy unparalleled transparency in what they own and why. It also means that each client effectively owns their own separate and discrete share portfolio, which is managed by us. We have partnered with Linear Asset Management, who are backed by the ANZ Bank for cash management, and JP Morgan, one of the biggest banks in the world, as custodian of your assets. We feel that this structure is the gold standard for your financial protection. In addition to this, we offer 19 separate and individual ethical screens that you can use to help tailor your investment. To ensure that your money is not being used to support companies that deal in areas and practices that you feel are important. By eliminating the areas that are only important to you, you keep the potential for higher returning areas that you might otherwise be ambivalent about, and these would typically be ruled out in broader ethical products currently available in the market. The name Nucleus comes from our ability to provide the core holdings of a client's portfolio, allowing them the time to explore areas that may be of interest or they may have experience in. We also offer a complete investment solution for those who don't have time to coordinate their own investments. Our investment team has decades of experience in world markets, and we have access to a global team of stock analysts. By removing the layers of middlemen that typically sit between your money and the markets, we've been able to reduce fees and provide unparalleled transparency in the solution we provide. For more information on what we can do for you, please call 1300 623 863 or contact us through www.nucleuswealth.com.
And coming up next week on Nucleus Insights, we've got our Quant Rocks Quality Edition. So that's same bat time, same bat channel, Thursday the 31st of May at 12:30 p.m. Eastern Standard Time. We're going to be checking or diving in to some of the quantitative investment strategies that are used at Nucleus Wealth, focusing on the quality side as opposed to the value side. But we will also be pulling apart some of our new analyst reports that are available in our new client portal. So for those clients out there that are listening in and who haven't checked out the portal yet, you can head over to the usual portal.nucleuswealth.com to have a look at what we've rolled out in the last sort of week or so. It's a fantastic dashboard of your account. Gives you a breakdown of a great number of breakdowns in sectors and regions, and you can dive right down to its stock level and bring up these analyst report pages, which are pretty involved, and hence why we're going to be explaining a bit of some of the background and logic behind those next week. So on that note, just finally, of course, we're available on podcasts, or wherever you get your quality podcasts from, anywhere on the web. iTunes and Podcast Addict are the two that we've found to work the best if you're on Apple or Android. And you can also check out all our previous webinars and podcasts there as well. Just finally, thanks for attending, and as always, Maddie will be sending around the survey for how we've gone. You can give us a bit of feedback on how we've gone today. Have a go at me for being a financial advisor if you like, but it'll also give us some topics for what sort of themes that you'd like for us to talk about it on our Insight series going forward. So on that note, I hope you've enjoyed today's webinar and podcasts, and look forward to catching you at the next one. Cheers.